Sorry.
Good afternoon, everyone. Thank you for joining us. Right, first things first, please can I ask everybody to put themselves on to mute, and you can leave your cameras on if you wish, but please do put yourself on to mute.
Is it filling? Oh, God. It's coming up.
Who's that? Who can I hear? Somebody hasn't gone on to mute yet. You're talking about the rain. Okay, thank you very much, everybody, for joining us today. We've got quite a lot to get through. I'm going to do a little bit of an intro and some scene setting, and then we will introduce our speakers. And then the idea is that we'll have a whole load of time at the end to do a Q&A. So save up your questions, and then we'll either do them over the chat or we will do them in person, depending on how we get on. Right, so let's switch on to the next slide. Well, there you go. So first things first, well, I'll introduce myself. I'm Alice Gill, the Exec Director of the Chamber of Commerce, and we're here to help you wade through the lots of information that is out there on tax reform at the moment. So there's two different work streams. There's the work stream which is looking into GST Plus and the package and how that will be implemented, because that's already been signed off as a package currently. And then there's the work stream that's looking at how do we change corporation tax and what does that look like. That's the one that's being consulted on at the moment. You have until the 27th of February to submit your response. Do read the consultation paper that has been published. It is really, really accessible, and sorry, I keep admitting people, and do submit a response. It is really important that we hear the business community's voice is heard in the response. Now, just to add into that little bit of a mix, with the GST Plus package, government are going to be debating if GST Plus package goes ahead, are they going to put GST on food or not? And that is taking place not next week, the week after. So there's going to be a huge amount of chat, I imagine, on that, which is why we're also running a webinar on I think it is Tuesday the 17th. No, Tuesday 24th. I'll send the link to the date on that actual webinar. So do come along to that one as well, so understand what's being proposed as that full package. What else do you need to know around the timelines? I think that's probably it at the moment. Corporation tax is the one to focus on at the moment. GST is being half debated this month, but it's only on food. And then both of those two work streams are going to be coming together at the end of Q2 to understand what goes into the final package. And is it a mix of corporation tax and GST? Is it just corporation tax? Is it just GST? And that's when we'll also get to have our say on that final package. Okay. And also, just so you know, I am recording this session. Right, I'm now going to hand over to the team so that they can introduce themselves. Di, do you want to go first?
I'm Di Jagare. I am Managing Director at DNA, which is a local accountancy firm with mainly local trading company clients, and also part of the Chamber Board where I'm Treasurer.
Thanks, Di. And Nikki?
Hi, I'm Nikki Forsher. I'm the Director of Tax Policy at the States of Guernsey, so heavily involved in both work streams on tax reform.
And Liz.
Yep, so my name's Liz Lenné. I'm the State Senior Economist. I work for the Treasury Committee. I am also quite heavily involved in both these parallel tax work streams that we currently have running.
Right, and I'm going to hand over to you two now to tell us what is on the table at the moment. What do we need to understand before we complete our corporate tax consultation responses?
Well, just bear with me a second while I attempt to share my screen.
Yeah, that's done. We can see you and your slides.
Okay, wonderful. Be able to move the slides, that would help. So this is just a slightly larger version of the diagram that Alice has already presented, showing the kind of parallel track approach. that that we are under at the moment. And as Alice said, we have a policy letter live coming for debate at the end of this month on Q1, which is the package that looks at the personal tax and contributions measures in the GST. And then we have the workstream 2, which is what we're here to talk about today, which is the work of the tax review subcommittee, largely looking around the options to how we might amend our corporate tax system and what the options are in that space. The intention is that we will be bringing those together in the summer for a final decision by the States Assembly at that point, and it is at that summer debate where we will see a final decision on whether it is workstream 1 and the personal income tax GST package, or some form of corporate tax changes, or some combination of the two, which is the recommended way forward from the States. Just to cover in a little bit more detail what is being undertaken in workstream 2, there is a tax reform subcommittee which is being chaired by Deputy Parkinson. Deputy St Pierre is also on that group, and Deputy Camp is also an observer on that group. We also have some very capable external experts who are sitting on that subcommittee and assisting with the development of the thinking. They are reviewing the alternatives for raising revenue from the corporate tax systems, and there's various options on the table which Nikki will take you through in a couple of slides. And they will also consider the workstream 1 package in its policy and compare that to the options around the corporate tax system, and whether there might be changes to one side or the other, or a combination of the two that might be the best way forward to the States. And as I said earlier, we are looking at publishing the findings of that subcommittee. The findings of the subcommittee should be going to the Policy and Resources Committee, hopefully a few weeks after we have the results of the consultation process in, and then that will be kind of delivered to the Policy and Resources Committee so that they can make their own deliberation on those recommendations and kind of combine those with thinking on a more broad scale across the scope of the state's financial work streams, in order to present some recommendations to states. So there's a few basic principles that we are working on in terms of tax reform. One is that it needs to make a positive contribution to balancing public finances. We need to deliver certainty and stability, particularly for businesses. It needs to be transparent, credible, and simple, and easy to administer. I think, particularly because we are a small jurisdiction, within that is really the thinking that a lot of complexity is quite difficult for a small jurisdiction to administer. So we need to keep it clear and simple to be effective. It needs to be internationally competitive, but also compliant with international standards. So that means looking at what is coming out of the EU and out of the OECD, and making sure that we are meeting the international expectations of what our tax system will deliver, as well as creating something that works for our own economy. And the third point there is that we want to create a system that is fair and perceived to be fair by the community. So I'm going to hand this one over to Nikki.
So just to give a bit more context to what we mean by internationally acceptable and complies with international standards. And when we're talking about this, we're most notably talking about the standards set out by both the EU Code of Conduct Group on business taxation and also the OECD Base Erosion and Profit Shifting Project. And I think it's worth pointing out that the amendments to our corporate tax regime back in 2008 were the result of the EU developing the Code of Conduct on business taxation, and that identified harmful tax measures in EU member states and their associated independent territories, with harmful measures being those that provided beneficial tax treatment that was essentially ring-fenced from the domestic economy. So there's a need that we meet those ongoing principles of the Code of Conduct Group's Code on Business Taxation. Otherwise, they're likely to put us on what is known as the EU blacklist, but its technical name is the EU list of non-cooperative jurisdictions, which comes with defensive measures and would make it very difficult for particularly the finance sector to carry on doing business. So any significant corporate tax changes in Guernsey could raise the likelihood of an external review by one of those bodies, so either the Code Group or one of the OECD BEPS forums. And I think it's worth understanding that those reviews take some time to complete. So you're probably looking at 12 to 18 months, and that period can create further sort of uncertainty for business. By way of example, the last time that a review was triggered was when the Code Group reached out in June 2017 at the start of them establishing their code of conduct, the EU blacklist, and it took us 18 months to conclude that review, which culminated in Guernsey introducing economic substance requirements for sort of globally mobile activity.
So this diagram, which we've lifted from the consultation document, if you are to go away and read that, is really to give an idea of kind of the broader landscape around taxing businesses in Guernsey and how that's changed. I think everybody is acutely aware that we changed the corporate income tax regime in 2008. I think what is maybe less apparent, particularly outside the business community, is that actually since then there have been a series of changes through other means which have changed the tax treatment of the community as a whole, and in this instance specifically the treatment of taxes applied to businesses. So concurrent with the decision for us to move to 0-10, there were decisions made around the structure of the social security contribution system that quite significantly increased the revenues generated through our contribution system, particularly from employers. That included very significantly increasing the upper limit on social security contributions. Also around the same time, there were quite substantial changes to the way that what was TRV and then became TRP is calculated, with again quite significant increases, particularly for office-based accommodation. There were changes to the way the company registration system was set up. Then subsequently, as time has gone on, we have evolved the way that 0-10 is applied. The 10% intermediate rate when 0-10 was first applied really only to banking activity. There have been kind of staged extensions of that 10% rate, and it now applies to most administering and managing regulated finance sector businesses. There have also been extensions to the 20% rate, so that now includes large retailers, hydrocarbons, cannabis, and income from property transactions. So there has been an extension of the application of the kind of non-zero rates within our corporate tax system, which has expanded the revenue that's available from there. Then in 2022, as part of the whole debate going on within tax reform in the last term, the states agreed a phased increase in social security contributions, again with a significant element of that coming from employers. And then most recently we have seen legislation come into effect to meet the OECD's base erosion and profit shifting agenda to implement what is known as Pillar 2, which is essentially a requirement the largest multinational entities in the world should have a minimum effective tax rate of 15%. So we have applied a qualifying minimum domestic top-up tax. I hope I got that right. that application went live with respect to profits generated from the 1st of January 2025. The current estimates is that will generate around £40 million a year, with the caveat that we won't actually receive any cash revenues from that until the first reporting cycle is completed in 2027. So there has been kind of in the background kind of an expansion of the revenues from the corporate sphere over the last kind of 10-15 years.
Okay, so I will take you now through each of the options in the consultation document, and just a reminder that it's open until Friday the 27th of February. You are able to just respond to some of the questions in the consultation document, so I would encourage you to respond, even if it's just to some of the questions, not all of them. So what are the options? So option 1 is a change in the way the 10% rate is applied. So currently in Guernsey, the 10% rate applies to the sort of regulated income streams. So this change would mean that regulated businesses would be taxed on all of the profits of the company, rather than just the profits that relate to that specific regulated activity that is within scope of the 10% rate. So this would align us with how Jersey apply their 10% rate. It is arguably simpler for business, but I think there is the potential that it could lead to business restructuring. So those businesses that carry on a combination of regulated and non-regulated activities might just choose to split their activities into separate companies. So as most of the additional revenues this would generate are from companies that are already in scope of Pillar 2. They're already included in the Pillar 2 estimates, which is why the forecast revenues that this would raise aren't perhaps as big as some people might expect. But it's also felt that this option is unlikely to impact on the competitive position or international acceptability, so it's unlikely to tip us into a review. So option 2 is an extension of either the 10 or the 20% rates to additional sectors. Now, there have been expansions of the 10 and 20% rates since 010 was introduced, and it now extends to most of the regulated activities in the finance sector. The sectors referenced in the consultation document are construction, retail and professional services. The reason those were selected is they are the next largest contributors to the economy after the finance sector. And there is also arguably some alignment if the 10% is extended to those sort of professional services prescribed businesses registered with the GFSC. So that would be legal professionals, accountants and estate agents. So with this option, it can be quite complex to define what is in scope unless there is another regulatory law to link to. So at the moment, how the 10% applies to banking sector, fiduciary sector, that's all linked to the regulatory law and the sort of specified regulated activities there. That can be a little bit more complex, trying to define what would be meant by construction, retail itself. We'd also need to make sure that we can continue to demonstrate that 0% remains the standard rate of income tax. And if we can do that, then that is unlikely to trigger an external review. The revenue raising of this option depends on whether you apply the 10 or the 20% rate and to the scope of additional sectors brought into scope. If those 3 sectors sort of given as examples in the consultation document are included at 10%, the revenues forecast would be 7 million or 16 million if at 20%, but that does assume sort of minimal behavioural change. Option 3 is an increase in what is the existing 10% rate to 15% rate. There would be no change to the 20% rate. So instead of 0, 10, 20 being the rates would be 0, 15, 20. Businesses are asked in the consultation document to comment on introducing this either unilaterally or, and I will say this would need to be subject to necessary engagement in alignment with Guernsey and the Isle of Man, just so that we can, the intention there is to draw out whether the sort of risks in going alone. As it wouldn't change the scope of companies subject to the 0% rate. Again, this one is unlikely to trigger an external review. The revenue raising from this option would primarily be from the finance sector, but again, the number might not be quite as high as you might anticipate, because some of the revenues would already be captured in the Pillar 2 estimates. The consultation document does assume a high level of behavioural change if Guernsey moved unilaterally on this, but again, we're quite keen to draw out views from the business community as to whether that is the right assumption that we should be making. Option 4 is a move to a territorial tax system, and again, this one is presented as either a territorial system at a 10% or a 15% rate. Again, no change to the 20% rate. That would still be intended to apply to those activities that are currently caught by the 20% rate. And the consultation document sets out that assumes an exclusion for fund managers and international insurance activity because of its global mobility. So what does a territorial mean? So it means that only the profits arising or derived from activity in Guernsey would be subject to the tax. So business profits attributable to permanent establishment, a branch in the island, there'd be an exemption for foreign income. So dividends from foreign subsidiaries wouldn't be subject to that territorial rate. It would require the introduction of anti-avoidance measures to prevent profit shifting. So we might have to introduce transfer pricing alongside a territorial regime. There might be a requirement for economic substance requirements to apply to a wider scope of companies than they do currently. At the moment, the economic substance requirements are generally applied to what are seen as globally mobile activities, so banking, insurance, fund management. But if there was a territorial regime, there might be an expectation that we introduced economic substance where to make sure that passive income wasn't being put to Guernsey with no substance. So it may increase compliance and admin costs to business, but again, we're interested in feedback in this area so that we can understand the impact to business of this option. And I think it's highly likely that moving to a territorial tax system would lead to an external review by the Code Group and the OECD. The revenue raising for this option does depend on the extent of behavioural change that we anticipate. So that's why the range of revenues from this option is so broad. So 3 to 15 million if applied at a 10% rate, but at a 15% potentially we could lose 5 million of revenues to gaining 18 million of revenues with this option. And that's when we're looking at the sort of behavioural change, we're factoring in so ETI and social security revenues from those sectors as well. Option 5 is the application of a government levy. So the feeling being that would be added to the current annual validation fees. In the consultation document, that's presented at either £250 per company partnership, which could potentially raise 5 million, or at £500 per company partnership could potentially raise 10 million. But I think, again, feedback on this aspect would be welcome, because a levy could be applied at different levels. It could sort of mirror the existing structure and application of how registry fees are set out. So it would increase costs to business, but it's unlikely to result in an external review, as it's not a tax measure. So that was a bit of a whistle-stop tour through the options, but again, there is information on each of them in the consultation document.
So I was just going to quickly cover some of the considerations that we need to take into account around behavioural change, and this is really part of what we are trying to draw out with the consultation document. So essentially what we know is that businesses and certain types of business in particular are very sensitive to particular things, including uncertainty around how their tax treatment will look in the medium term, any actual changes in their tax changes when they finally pull out, and uncertainty about where Guernsey stands in terms of its relationship with the EU and its compliance with international standards. The way companies might respond to these different considerations is highly dependent on the specific nature of those businesses, which makes it very difficult for us to predict what they might be. And that's one of the reasons why you see such large ranges attached to some of the revenue projections for these options, is because it is so difficult for us to predict how businesses and their clients might respond to some of these changes. What we do know and we do expect is that in some areas what we might see is that it might make it difficult for businesses to attract new clients to Guernsey. It might make them change their business decisions if they are already here, so they may decide maybe not to expand in Guernsey if they are looking at consolidation decisions with perhaps other areas of their business which are located elsewhere. It might tip the balance of where that consolidation decision sits. What we also know is that these changes can have impacts wider than just the generation of corporate income tax, because if we see substantive behavioural changes in response to changes in the corporate tax, and that also has a feed in through employment and earnings in Guernsey, it's also going to start impacting things like our personal income tax receipts and social security receipts. So we need to consider that as well when we're looking at the kind of broader potential response to any potential changes. And one of the things I think we want to test with the consultation document is whether the business community feel that the assumptions that we're making around the potential risks and the potential behavioural change are right, whether they're understated or overstated. So we just would like to draw some of that information out. And so really, in summary, that consideration is really about helping us find where the balance is in these options between the potential reward they might generate in terms of additional revenue for the government and the economic risk that might be attached to changing the tax base. And just going to finish off with a reminder that we do have quite a complicated profile of work going on this, and a reminder that in the context of the whole political discussion around tax reform, this is the second work stream. We are also running work stream 1. Again, there is a debate on that at the end of this month, and we will be looking at bringing the considerations around the GST and the personal income tax side and the discussions that are subject to the consultation document that we're discussing today together in the middle of the year for the political assembly to make a decision on the most appropriate way forward. So I think that is all our slides. So
super, thanks ever so much. So now we are on to the Q&A section, and there aren't any Q&As, any questions in the chat yet. So I suggest if anyone does have a question, raise your hand and we can handle it that way. I've got one question which I don't think we covered off in the throughout the presentation, is in terms of timelines, what the decision will be made in May, June, fingers crossed, because we need a decision. In terms of when will the application be? When can people start seeing some changes from this?
So I think on when you might see some change, I think the answer will be it depends, because it depends on the extent of the change. If it's changing the current 10% rate to a 15% rate, then actually that's not a significant amount of change and could probably be put into effect fairly quickly. If it's something like a territorial tax regime that is put forward, then actually the legislation will need to be developed. There'll need to be quite a lot of guidance. So I think on that one, you probably would be looking 18 months to two years on that. So yeah.
Super, thank you. Can't believe it. There's not one question, not one raised hand. Let me just check my little list of questions that we prepared to see if there's anything that you haven't covered, but you did a very thorough presentation. So, oh, hang on, Layla's got her hand up. Go for it, Layla.
Hi, thanks very much for the presentation, very helpful. Can you just go back on with a bit more detail over the territorial option in terms of how it would affect, you did mention passive income. Can you explore that a little bit more, what you have in mind and what is meant by activity in Guernsey?
So that's a very good question, and I think the answer is that different jurisdictions do apply territorial regimes in slightly different ways, which is why there would need to be, if it was a territorial, there'd need to be a slightly longer implementation period for that, because there would need to be a period of consultation with industry as we developed legislation, guidance and things. So generally in what you would probably consider similar jurisdictions to Guernsey, then generally in a territorial regime they will not, they'll have exemptions for passive income. So foreign source dividends, foreign source royalties, foreign source interest would not be subject to the territorial regime, because it wouldn't have arisen or derived from activity in Guernsey. But what you would look to bring into the territorial regime is where the activity takes place in Guernsey. So it's quite easy when it's a shop. You can quite clearly see you've got a shop on the high street, all of the activity and it takes place in Guernsey, and all of the profits are arising or derived from that. It can get a bit more complicated when you're looking at sort of other business models. So perhaps where you've got managed entities is the activity of the manager, so the trust company. Does the activity of that company in Guernsey mean that the underlying entity profits would be brought into a territorial regime? And that's where we say it gets a bit more complicated from a sort of compliance and admin perspective.
Yeah, I'm thinking, and forgive me if I've overlooked something completely obvious to everyone else, but investment advisory services taking place in Guernsey. I advise you to make this investment. You sitting outside Guernsey may or may not do so. The activity is your decision taken outside Guernsey. My activity is simply bringing those investment opportunities to your attention, telling you about the risk and reward, but you're the one who actually makes the decision to go forward. There, I'm wondering, is the activity that generates a profit for the company my advisory services in Guernsey, or is it the decision that is made to pursue that investment where that decision is made outside Guernsey?
And I think that they're the kind of things where sometimes it can depend on the facts and circumstances of the situation, where the balance of where the activities are taking place, where the decision is made, which is why it can be more complex for business.
So and absolutely the sort of thing we need to draw out during this consultation so that we can nail it down.
Yes, I mean, I can see that what I would frame my question in terms of looking at the wording in the consultation document, only profits arising or derived from activity. And I would ask you in my response to the consultation, what do you mean by activity? So it wouldn't actually, the question I'm raising or the comment wouldn't tease out the answer. It would merely result in your view being that, yes, this is a difficult thing and we'd have to go look at careful legislation and definition and guidance. So it won't give me an answer to that question, and I can understand why, but it will just, the more people who raise that same question, the more you'll see industry is saying this is a difficult one, and it could cause enough anxiety that it heavily weighs on the risk side rather than the reward side. Is that what you're trying to, is that your expectation of
yeah, I think you draw out an interesting point, that perhaps the wider community wouldn't necessarily appreciate, that if you have a very standard domestic business, the application of these kind of taxes can be relatively straightforward. Where you have international businesses with much more complicated structures and much more international dealings with interactions with other tax bases, it does get much more complicated, and it requires a lot more complex administration on both sides to manage that kind of process.
But you did say that territorial will probably raise more tax from the finance industry than from other sectors of industry. So it's a very real question for the finance industry.
Yeah, it absolutely is, and part of that is simply due to the balance in scale between the finance sector and the professional services sectors in Guernsey relative to the domestic sectors. I think the domestic sectors are very visible to the public, and the finance sectors are less visible. But in terms of their, particularly under 010, given the application of the 10% rate, the contribution of the finance sector is several times larger than the contribution of domestic sectors, and that's possibly not something that the public are necessarily aware of.
Although they might expect that the profits generated by the branch of Boots in town should yield some tax for the Guernsey.
And not knowing the specifics of their financial situation, I couldn't guarantee, but there is a large retail rate, so 20% is applied to retailers over a threshold level.
Currently?
Yes.
Yeah. Yeah. Okay. Right. Thanks.
Do we have any more questions?
I'll ask one, Alice.
Go on, Di.
So for the sector extension, I'm thinking like for SMEs, in the behavioural changes, does that consider like the fact that that's going to constrain growth of them? Like, I think we don't do anything really to support SMEs at startup, but we have a real thriving community of startup businesses who grow into bigger ones that I certainly wouldn't have grown my business so much if I hadn't been able to reinvest in the same way as I have.
Yeah, it does consider that there will be some level of behavioural change attached to those domestic businesses. Generally, the assumption that responses to tax changes for domestic businesses, sorry, that's the lights going off. It's the same problem they had in the live stream the other day, if anybody was watching that. What was I saying? Yes, domestic. Yes, the assumption is because domestic businesses are kind of locationally restrained a lot more, then they are less likely to suffer substantive behavioural change than, say, a business that could move its entire operation somewhere else. But there is an expectation that some businesses might make different decisions, whether that be the number of people they employ, whether that be the expansion of their business more generally. There is an inclusion of an adjustment. Again, those decisions are very specific to each individual business. There is also an assumption that actually what we know is quite a lot of businesses are distributing their profits. So companies with locally resident shareholders under 010, when those profits are distributed, they are taxed at the standard rate of personal income tax, less any tax that has already been paid. So there is an assumption that there's a reduction in the tax we would be getting from the tax on distributions, because we would be collecting more of that tax upfront. What that means is actually the potential revenues generated may be less than perhaps people might have imagined.
Yeah. Oh, you're on mute, Alice.
Classic. I was going to say, I haven't got any more questions in the chat, and I haven't got any more that we had prepared, because we've covered all of the topics that we said that we would cover. Unless anyone else has got anything that they want to raise, I will give everyone 20 minutes back of their day to go off and get, oh, hang on. Got one. Yes, go for it, Layla.
You're on mute, Layla.
Yeah, so I'm with Alice on that classic one there. I don't want to seem as I'm hogging the stage, but I have put some thought into this. And could you take us through what you anticipate doing in terms of if you were going to increase the top line rate in conjunction with the Crown dependencies? How would you go about raising that?
So I think it's fair to say that I think there's elections in both Jersey and the Isle of Man this summer. So I suspect political discussions wouldn't commence until after that election had taken place. In terms of increasing the rate from, say, 10 to 15% from a legislative perspective, it's quite a straightforward, and from a system change perspective, it's fairly straightforward change to the legislation. But I think it's understanding if business would need a lead-in period to such a change.
Yeah, and I think the key consideration with that step is the picture and the potential behavioural response to a change like that is very different if we were to do it alone and in isolation, or whether we were to do it in conjunction with the other Crown dependencies, and Jersey in particular. I think we're kind of quite conscious that having a very obvious differential in the rate between Guernsey and Jersey could be difficult.
But what I'm trying to get to is whether any of the other two jurisdictions have raised this themselves, because if we were the only ones to raise it with them, the reaction presumably would be Guernsey's struggling financially and needs to raise money. Well, that's obvious, but we're doing fine because we've not actually had to worry about that. So from a sort of presentational point of view, have either of Isle of Man or Jersey raised this themselves?
So I think it's fair to say that over the years since 010 was introduced, there are fairly regular Crown dependency political meetings between chief ministers, treasury ministers, and the rate comes up from time to time. When it was last discussed at a political level, but that wasn't with the current political committee. Both the other two islands wanted to understand how Pillar 2 played out and how that impacted on their island's finances. So again, I think it's probably one that there's an election in the other two islands, so
yeah, I think Jersey's elections in June and Isle of Man's in September, so yeah. I imagine it will be
so
election discussions.
Yeah, so there'll be election discussions. It will be raised as it usually is across the three islands, and I think it will just see how it plays out. But I think in terms of the other two islands, I think that historically they've wanted to understand the impact of Pillar 2 before they looked at further corporate tax reform.
But from that, I read impact and receipts. So they will actually possibly say, we want to understand the impact of Pillar 2, but now we also want to wait until we start getting money in. So that pushes it even further down the line. And I'm also reading from your response that at no stage up until now have the other jurisdictions raised the possibility of changing the rate.
And I think it goes back to the three islands have different taxes in play. Both the other two islands have some form of GST, VAT, so their financial levers are slightly different to those available to Guernsey currently.
We can't necessarily kind of preempt the political discussions that might be held in those spheres, particularly for politicians outside of Guernsey. Not trying to be deliberately invasive on that. No. It's just a difficult question for us to answer for you.
No, but you've actually answered it very well, because if you look at it from the outsider's perspective, you've put something in your consultation document that talks about discussions with CDs, potential discussions. What we don't know as outsiders of the political process is whether there have been any preliminary discussions, whether recently or in the past. And I don't, from what you're saying, I don't think there have been. Thanks.
Okay, I am going to call it a day. So everyone raises their hand now. But I will say thank you ever so much, Liz and Nikki. Great presentation. Thank you so much for sharing your time with us this afternoon. It is much appreciated. We will send the recording round to everybody afterwards, so you can listen in again in case there's anything you've missed. We'll include the link to respond to the consultation. Please do respond to the consultation, everyone. It is really important that we do. I've also got a Word document of all the questions, so if you want to start prepping your answers before you go into the survey and put your final response in, that's quite a useful way of collaborating within your company. And I will also include the link for our GST Explainer webinar, which is a date that I can't remember still. So thank you ever so much, and speak to you all soon.